Good afternoon. Welcome to LBMA webinars. Today we have David Gornall from LBMA, we have Adrian Ash from BullionVault, and we have Saida Litosh from Refinitiv, and they are here to talk to you about volume by price insights in terms of LBMA trade data. Before I hand over to Adrian for setting the scene, let me take you through a bit of housekeeping. If you do have any questions throughout the webinar, please submit those into the Q&A panel. They should be either at the bottom of your screen or top of your screen, depending on which version you currently have. If you cannot see this, you don't know where it is, where to find it, what I'm talking about, just send an email through to ask@lbma.org.uk. You can use this during the webinar, or if you're watching the recorded webinar back later. So, Adrian, are you ready?
Let's go. Thank you, Taylor. So good morning, good afternoon, and good evening to LBMA friends and family around the world. I'm glad you can join us for this, the fourth LBMA Trade Data webinar in the LBMA's webinar series. Just as a quick reminder, the LBMA Trade Data project began in 2018, implemented and really brought together by David Gornall, Senior Advisor to the LBMA, with the purpose really of uncovering, what's actually happening under the hood with over-the-counter OTC London gold, silver, platinum and palladium volumes. David and I, it's a little over 12 months ago now, we first looked at London trading volumes compared to New York COMEX during the initial phases of the COVID crisis, and we found that London had overtaken the COMEX as a lot of business shifted to this side of the Atlantic. We then took a look earlier this year with Fergal O'Connor from Cork University at liquidity during a couple of moments of crisis last year, both for gold and for the wider financial markets. Rona O'Connell at StoneX then took a look with Bloomberg at the interaction between volume and price, and often her finding was that volume often precedes price. You see a movement in volumes before you see a movement in price, which I think is very interesting insight. And today we're going to look at volume by price within the daily buckets of data which the LBMA Trade Data project throws out. Joined by David, again, thank you, and Saida Litosh from Refinitiv, where the LBMA Trade Data is now available, and where for the first time, the volume in price tranche data is available for the first time. So we're going to be looking mostly at first half of 2021. We're going to be looking at three metals, some particular events for gold, for silver, and also for palladium. It's been another action-packed session for precious metals markets so far this year. We had the silver squeeze phenomenon back at the start of February. We've had a new record price in palladium at 3,000 bucks. We've had 6-year highs in platinum as well. We then had a double low for gold at around 1685, and now we're back up towards 1900. So let's take gold first of all. Saida, if I can come to you. Taylor, if we can move to the first slide, please. Saida, do you want to talk us? So this is not London OTC volumes, right? This is what's happening in terms of end user demand, correct?
Yeah, so here, hi Adrian, yes. So here we have total physical gold demand against ETF flows. So just to give you a bit of background, we saw a rebound in gold physical demand in Q1, up by 25% year on year. This was primarily driven by gains in jewellery demand and retail investment. Jewellery sector, which roughly accounts for half of global gold demand, was one of the worst hit segments during the pandemic last year. Demand rebounded by over 40% in the first 3 months, and this was largely driven by recovery in key Asian markets, including China and India, where demand revived as the economies continued to re-emerge from the pandemic. This was also helped by the festival period and lower gold prices in local terms. I should also mention that despite a strong year-on-year increase, demand was relatively subdued on a historic basis and was down by double-digit percentage compared to 2019 levels.
Wow, okay. And so what we're looking at there in the gold line then is then showing us what's happening in the ETF investment products.
Yeah, exactly.
And that's on the right and that's inverted, right?
Yeah, that's inverted. And on the ETF side, it was quite an opposite story to physical demand. So just to add a little bit, I mentioned strong gains in jewelry sector and also we saw a strong rebound in retail investment demand, which is investment demand for bars and coins. Exactly. And again, it was driven by a resurgence of demand, mostly in Asia. And there was also an element of opportunistic buying, as lower gold prices in many local currencies were seen as a good timing to re-enter the market, especially given that expectations around the price outlook remained on a bullish side. So that's one story. And on the other hand, we witnessed a shift in sentiment towards gold among the professional investor community, which pretty much started towards the end of last year and accelerated since the beginning of this year. And this was evidenced by liquidation from ETF investors, who reduced their global holdings by over 170 tons in Q1. So just to put this into perspective, gold ETFs witnessed a record amount of net inflows of around 900 tons over the course of last year. And Q1 selling represented the second consecutive quarter of net outflows. This also compares to net inflows of around 300 tons in the first quarter of last year, and represented the largest net quarterly outflow since Q4 2013.
Okay, which was the gold price crash year of 2013.
Yeah,
it's interesting. I mean, I think the connection between these two. Somebody said to me once that gold's physical market, household demand, technology demand versus investment flows through ETFs and so on are an identity. You see this relationship where if one is falling, the other will be rising, and net the market is always pretty much balanced. So I think that chart demonstrates that really nicely. Taylor, if you can move on to the next slide. So thank you, Saida. That's what was happening in end user physical demand ETF products and for bar, coin, jewelry and tech. This therefore shows us, well, what was actually happening in London, in the center of the global gold market for large bars. And I think you can see here, this is obviously showing you from middle of Jan through to this week. And what you've got there, I think, is an interesting connection between what Saida, you just said about the drop off in ETFs, obviously, the net selling, and the impact on price. And you mentioned that household demand, jewelry and retail investment obviously picked up very strongly in Q1. That was clearly aligned with the price drop, right? I mean, that was very helpful to the pickup in household demand, would you say?
Yeah, definitely, absolutely.
Okay, so what we're looking at here then is, you can see gold got down to, and it touched it twice, 1685, around that level on the PM London LBMA gold price benchmark. You can see how volumes weren't particularly dramatic around that period. So David, I think it's interesting to look at what we're seeing there in terms of volume. I mean, is there anything that stands out for you? So this is total OTC volumes here. This is across all products. Is there anything that stands out for you from this particular chart?
I think when you go into the price tranche chart on the next slide, you can see what's happened over those two lows. So I think what we should probably introduce here is this concept of volume in price tranche, because a lot of people might not know what it is. Yeah. So
Taylor, do you want to go to the next slide, please?
So I think if you're not familiar with it, what the data does is it gathers up all the trades from all of the reporting entities each day on a 24-hour period, and to get a central point, an average, they use a Windsorized price at NASDAQ to give a mean average.
So NASDAQ are collecting the data from LBMA trading members, right?
Collecting the data from the registered reporting entities. And then each of the tranches is created by using a 0.25% move up or down from that central pivot point. And that's going to become a little bit clearer a couple of slides later.
Okay.
When we look at it in tabular format. But I think what we were looking at was those two lows, and we were trying to figure out if there was anything meaningful in that data when we looked at this volume in price tranche, or VIPT as we call it. And what we found on gold was that the vast majority of trades were above the auction price. So we took the nearest pivot point, the nearest tranche point to the
in that day's data.
In that day's data,
yeah.
And we found out that the vast majority of it, 64% of it, traded above that auction price of 1687.
Yeah, and that was on the first touch on the 8th of March, and then on the 30th, which is the retouch, it was even greater. I mean, there was very little volume being done below that day's PM fix, right?
16%, I suppose, or more. More insightfully, it's 84% of it was above, and we haven't seen that price since then. So I think this was quite valuable in trying to mine this data to try and figure out what volume in price chance was giving us. Okay,
thank you, David. Taylor, can we just go back a slide, please? Sorry, if we go the other way. Thank you. So bearing that in mind, those two touches there, as David said, on the 8th of March, you had only a third of that day's volume was below that price there that you see. And then even less of that, only 16% was below that price again on the second touch on the 30th. Saida, did you just want to talk us through, what was happening in the broader OTC market with these volumes across that period that we're looking at?
Yes, sure. So we can see quite a spike in gold volumes between late February and early March. So we saw a daily average of around 37.4 million ounces. And that's compared to 32.6 million ounces for Q1 average, with 45.
Which is the dotted line, right?
Yeah. And then we saw 45 million ounces reported on the 24th of February, which was the highest volume day for the whole of Q1. And then 43 million ounces on the 3rd of March, which was the second highest volume day. And as it was previously noted, a spike in trading volumes tends to indicate a change in price direction or a correction. So indeed, one can see from the charts that high trading volumes during that period coincided with sliding gold price. So we saw gold price at $1,817 per ounce on the 15th of February, and that fell to below $1,700 per ounce on the 8th of March, which was down by 7% during the 3-week period. Interestingly, volumes again picked up towards the end of March to about 36 million ounces, not by as much as we saw early in the month. And this happened just before gold slipped again below the 1,700 ounce level. And at that time, we know that gold was under significant pressure due to strong US dollar and rising treasury yields.
And again, there were those ETF outflows as well.
Exactly, yeah, it was reflected in ETF outflows.
Yeah.
So I guess another interesting spike here, which we can mention, is at the end of April, when we saw volumes rising to nearly 50 million ounces, which was actually the highest volume day for the whole of 2021. And if we look at the breakdown by product, it was entirely driven by a surge in gold forwards to 31 million ounces on the 29th of April, which was 3.2 times the average for 4 months.
Wow, okay. David, so I mean, with the forwards, David's vanished, David's back. Just with the forwards, that heavy forward volume then towards the end of April, I mean, do you think that might have been producers selling to lock in prices for fear of prices going lower again?
It could be a number of reasons. It could have been that. It might well have just been some rolls with interest rate movements. It could have been some arbitrage between CME. It's quite difficult to pin down, but it could have been any one of those.
But with the data that's now available, you can obviously pick out which product, as Saida says, you can pick out which product, whether it was spot, forwards, lease loans, or options, that was actually driving the bulk of that.
Yeah, you can pick out, well, the forwards have been largely responsible for the larger part of the volume of the overall data after spot. So it's the second biggest data set, yes. But it is quite difficult to understand unless it's right at the end of a CME month. If it's a COMEX deliverable month, then you'll see a lot of rolling forward going on, and you'll see quite a lot of activity in the OTC market as well.
Okay.
The other side of that trade.
Okay, great, thank you. Taylor, if we can go on 2, please. And the next one. Thank you very much. So, okay, so the trade data, Saida, is now available on Refinitiv Eikon platform.
Yes, so we're quite happy to announce that LBMA Trade Data is now available on Refinitiv Eikon platform, and it can be accessed by typing LBMA Trade in the search box. So it provides a daily insight into the size of the OTC market for precious metals, covering gold, silver, platinum, and palladium. And as Adrian mentioned, in addition to total trading volumes and product breakdown, we also have volume in price tranches data, which provides interesting insights into post-trade prices and volumes on the OTC precious metals market.
Indeed. Taylor, can you skip on one, please? And so this shows us the data for the 7th of June, so Monday of this week. Over on the far right-hand side, you can see the update date there is the 8th. That's when the data was released. David, do you just want to talk us through how this works? Because I think a lot of people might struggle just looking at understanding quite what's
the
going on.
idea of putting this up, wasn't it, to try and give a tabular form of it. So as I just mentioned, that the average spot price for all of the day's trades on the 7th of June.
And that's a 24-hour window, midnight to midnight, is it?
That's it's a 24-hour window. The cutoff is 7 a.m. in the morning.
Okay.
And you'll see from this that the centralized Windsor average price, whatever you want to call it, is 1889.56. And then there is a distribution of volume according to these ranges of 0.25%. When we get to the extremities, because we can't use a table that's going to go on ad infinitum, we've captured all the moves above and below 0.75% from that central point in one bucket. I suppose the interesting thing about this one is that you can see there was a very low volume in the 75 to 50, the second line down, of only 4,000 ounces, and then underneath that, although it's a much larger bucket, you've got over 500,000 ounces there. So this would typically be what you would get to see and what you would get as part of your subscription to the VIPT data.
Okay, fantastic. Thank you very much. Right, so if we look at this in another way and look at silver, Taylor, if you can skip on for us. I believe, yes, so what we've got here is total silver OTC volumes, and you see the big spike there. You can see price in black, and that's on the right-hand axis. And this is the silver squeeze, hashtag silver squeeze phenomenon from the end of January and early Feb. As you may remember, Reddit, chat room, forum, the Wall Street Bets group on there, they had been attacking heavily shorted stocks, particularly beaten down stocks on the New York Stock Exchange, where hedge funds, they guessed, had gone heavily short. And the initial prompt on this activity was just to look at a table of which were the most heavily shorted stocks and basically buy them with a view to trying to squeeze the shorts, so that those people who had bet against the price rising and had bet that it would go down by borrowing the stock and selling it would be forced to buy back their position to cover their position at an ever rising price. And this has worked phenomenally well as a kind of hive strategy for most retail investors in things like GME and AMC. We saw it again in Clover this week, I believe. On the 27th of Jan, somebody on Reddit said, hey, we should do silver because silver's heavily shorted. Let's squeeze silver. Now, it's not quite how it works because there is no large naked short in silver. But what did happen was the price did spike, and really quite phenomenally. So in particular, the Reddit group called for people to buy the SLV silver ETF, the iShares product. And Saida, if I'm right, that added something like 3,400 tons in 3 days because of the sheer surge in the size of its shares outstanding. I mean, I make that about 12% of annual mine output in 3 days, which is really quite something. And we can see here basically what was happening in the OTC volume at the same time as this narrative from retail investors, the short squeeze narrative was going on. Saida, do you just want to talk us through, what we're looking at here, and what this tells us?
Yeah. So we can see that silver volumes surged to 1 billion ounces for a couple of days, which was on the 1st and the 2nd of February. And we saw the silver price shoot from under $25 per ounce on the 28th of January to an intraday high of over $30 per ounce on the 1st of February, which was quite an impressive 21% increase in just 3 days.
Yeah.
So as mentioned before, a spike in trading volumes tends to indicate a change in price direction or a correction. And indeed, we can see that those heavy volume days happened right before a change in the trend. So with silver starting a bear trend and sliding to $24 per ounce by the end of March.
Okay. Yeah.
And then we can see that obviously the following months were a lot quieter, with April volumes at around 305 million ounces and May average volumes at around 326 million ounces. And that's compared to over 400 million ounces we saw in Q1.
Okay, so those 1 billion ounce days are really quite something. I mean,
Yeah.
I mean, obviously the LBMA trade data goes back to 2018, but it's difficult to imagine there's been a bigger single couple of days, certainly in recent history. David, would you say?
It's never exceeded those numbers now.
Yeah, yeah. Taylor, if you go to the next slide. So what was actually happening on the 1st and 2nd of Feb, where we had those billion ounce days? And David, again, what we've done here is we've looked at how much of that day's volume was done above and below the benchmark price, the midday London LBMA silver price. So David, what did we see on that 1st of Feb, which is where we almost touched? I think the fix that day came in just shy of $30.
Yeah, it's not actually. This one's not really helpful, is it, Adrian?
Well, I mean, it shows you there was a lot of activity above $30. I mean, I think that's what's interesting here.
Nicely at 50. That volume, I think, was 800 million ounces, evenly split above and below the auction price. The second day wasn't as much, so I think on the spot side of it, it was just above 600 million ounces, so 60% of the total volume that day. Where the relationship isn't as strong.
Well, the price had come down by then, so I mean, I think that's 60% above the benchmark price.
That's right. We were almost
actually coming in because I think we were down about $2.
20, just under 27 and a half.
That's right.
45, I think the auction was on that day. Yeah, so there's a slightly stronger relationship there to say that the volume is telling you something, but clearly not on the 1st of February.
Yeah. Okay. Taylor, if we go to the next slide, we can again drill down using the new data available from Eikon. We can have a look at what's happening with the different product groups. Saida, I mean, do you want to talk us through what we're looking at here?
Yeah, sure. So some interesting observations here when we're looking at trade volumes by product group. So if we look at those two specific days of high trading volumes, we can see a sharp increase in forward volumes to around 290 million ounces on the 1st of February, and then nearly 350 million ounces on the 2nd of February. And this compares to around 115 million ounces for Q1 average. So quite a big jump. There was also an increase.
That was in the forwards.
Yeah, in forwards, yeah. We also saw an increase in spot volumes to 686 million ounces on the 1st of February, which was 2.8 times the Q1 average, and then 620 million ounces on the 2nd of February, which was 2.5 times the Q1 average. And so basically we saw an increase in both products, but what was quite interesting is that the average spot to forward ratio actually dropped sharply between the 29th of January and the 2nd of February. So on those 3 days, we saw an average ratio of 2.07 to 1, and then it dropped sharply on the 2nd of February to 1.78 spot to 1 forward. And this compares to an average ratio of 2.37 to 1 for the whole of Q1, if we exclude those 3 days.
Okay, so that's spot rate, that's spot versus how much has been done.
Yeah, so it's basically suggesting that we saw a larger increase in forwards. or a bigger proportion in increase in trading volumes was driven by forwards.
Okay, and David, I mean, you said previously on gold, obviously we can't necessarily guess quite what was driving the forward action there, but would it be a relatively safe guess to assume that some producers saw silver touching $30 and thought they might take that as a forward price to lock in?
Well, it was very tempting. I'd say the other noticeable one was is looking at that red spike at the bottom, which was the options, which is coming in at around the same period at the end of the month there. But
actually slightly ahead of the peak volume day. That's right.
Yeah, so I think that was on the evening of the Reddit's chat rooms.
Mm-hmm.
So I think that was probably one of the biggest option days.
And so, I mean, given what happened to the SLV, I guess that would kind of suggest that there were some traders who were basically trying to take a position, knowing that the Reddit crowd had come for silver, and obviously looking to either prepare for that or to exploit that.
Yeah, I think there was a lot of positioning throughout that week. That's very clear in the increased volumes of not just spot, as I said, with the other price sensitive sub-products of forwards and options, because you can clearly see that in the loan lease it hasn't really moved there. I mean, it's a very slight increase. So I think everybody was involved in all three products there. Yeah.
Okay, thank you very much. Taylor, if you move on, we can just have a quick look at how Eikon actually presents this data, just in terms of, so a daily bucket of data for the product groups. This is for gold. Again, this is for Monday because the update is from the 8th. So over on the far right-hand side, you can see total volume in gold from Monday in spot. Going back to the left-hand columns, you can then see swaps and forwards. And you can see that there was 4.1 million ounces done for spot forwards. On 1 week forwards, there's 1.8 million, 1.1 on 2 weeks, and so on down tenors there. You can also see the options moving along one column, and again you can see them by tenor, and then moving on again you can see the loan and lease and deposits, and again by tenor there. If we go on to the next slide, we can then see the reason that we wanted to look at that quickly before we come to Palladium. So Palladium also had a pretty excitable first half of 2021, and there's some really interesting stuff going on here. We just wanted to have a look. Obviously, the narrative here is that Palladium's approach of $3,000 an ounce came following major producer, Russian producer Nornickel, who had flooding at a couple of mines, if I remember rightly. Saida, is that correct?
Yeah, flooding at two of their main mines, which roughly account for like over a third of total production by Nornickel.
Okay, and that led them to reduce their forward guidance for the year. I think that was mid-March, right?
Yeah, mid-March, yeah.
Yeah, so I mean, you can see that big spike there in price, and you can see a spike in volume. But I mean, do we think there's anything, is it always that volume tells us something interesting about what's happening with price, David?
Yeah, this chart is a great example that it doesn't always, does it? I mean, I tried to pick the bones out of this and couldn't really see anything apart from where those announcements were made with Tymirski and the other mine. But I think that that volume remains pretty constant whilst the price has climbed to its all-time high and back down again with a couple of spikes of spot. So I'm not sure that this chart is as insightful as the others.
Correct, because if we go on to the next slide, Taylor, there is then, however, we can have a look at that $3,000 print for the PM Palladium LBMA price fix. And here, I mean, I think it's very interesting that, you can see the vast bulk of trade on that day, David, was being done below that 3,000 print. Yeah,
74% or 26% on the other side. I mean, I just wrote down what that was. It was 647,000 ounces there and 169,000 on the other side of it. So I think that was a pointer, and we haven't seen that price again.
Yeah. So again, the distribution there in the volume. If we go on to the next slide, Taylor, David, do you think this is more insightful for the period that we're looking at? So this is for March. So this is the period of Nornickel, and this is where we actually look at which product groups are on lease and loans here, aren't we?
Yeah, this is quite an extraordinary product because we've never before seen any data for interest rates in any metals, and certainly not, probably more in the case of gold and silver, when we had the benchmarks in the past, but not for platinum and palladium. And I think this holds a great deal of interest for a wide range in the precious metals community, because now this data is able to tell you the distribution of interest rates on a daily basis. We've just highlighted this for March to give you a bigger picture, but it's giving you the spread of where the leases and loans trade. So this is where palladium is treated as a currency, and this is the interest rate that's attached to those trades. And what this is telling us, quite interestingly, is that it's not the short dates as some would expect. It's the 9 months in purple, which is showing the highest volume, followed by, and I think there is a bar missing, this, the cerise.
Yeah, I think you're right.
I'm going to improvise a bit here. Is the cerise colour, which is 1 year plus. So that's quite long dated. And then the distribution of interest rates is broadly concentrated in the 2.5% to 3% range. You have to remember that the system doesn't have the ability to take into account what's collateralized, what's uncollateralized, what's a AA plus entity, what could be a BBB, and that's why you've got this spread from 0 going all the way up to 8%. So I think this is helpful to the marketplace as a whole to throw some light on what's going on in all 4 of the metals when we're looking at the metals as currency, as a fixed income type of product.
Okay, so on the lease and loans there, I mean, I presume a good chunk of that would obviously be automakers, right? I mean, basically looking to lock in supplies for the future.
Almost all of this is going to be related to the catalytic business, yes.
Yeah, okay. Thanks, David. If we go on to the next slide then. So Saida, these are the codes, the RIC codes on Eikon for accessing the LBMA trade data.
Yeah, so there's a few options how you can actually access LBMA trade data. So one option would be directly on Eikon terminal. And again, you can either type in LBMA trade in the search box, and then it will take you to the main overview page. And from there, you can navigate through various pages. Or alternatively, you can use one of those 3 codes listed on this slide to search for a specific piece of data. And also another way would be to actually access the data directly from your Excel. So you can just search for a specific RIC code via Refinitiv Eikon add-on.
Okay, fantastic, thank you. Okay, Taylor, I think if we're ready to go to questions. Okay, here's an interesting one. When we're looking at the data, maybe David, this is for you. Do we tend to see volumes across the 4 metals, or particularly maybe across gold and silver, actually rising and falling together? I mean, is there a relationship of precious metal volume?
You can see them rising broadly, but there are breaks in it. So if you were to look at the first and second in silver, nothing like doing a bit of analytical stuff on the hoof, is there? Yeah, for the 2 big silver days, if we were to look at gold, to prove your point, we've got 20 and 29 million ounces of gold. So there's nothing extraordinary. So that would suggest it in that particular case, it didn't. So
silver was literally off on its own that day.
It did its own thing. Gold saying, "Yeah, you're my noisy neighbour," and we're not moving. So I think, broadly speaking, we do see overall volumes moving when they're moving slowly. When the trend is moving slowly upwards, you'll see them all increase. But when you've seen the spikes, they are completely disconnected from the other 3.
Right. Okay, that's very interesting. Okay. One for Saida here. What's your outlook for ETF inflows for gold over the rest of 2021?
As for ETFs, I think we're likely to see a sharp drop in net inflows this year compared to a record level witnessed in 2020. So as I have mentioned at the beginning of the presentation, we have already seen an acceleration in selling in the first 3 months. More recently, we have seen a slowdown in outflows and a return to a modest buying in May. But I think further liquidation is very well possible in the coming months, particularly if we continue to see positive economic data supporting a faster than expected economic recovery and further rise in treasury yields. So on the other hand, if economic recovery momentum starts to slow and we see a COVID situation worsening again across many parts of the world, investors are likely to become more risk averse and resulting in fresh inflows into gold ETFs.
Okay, thank you. This is an interesting one. Now that we've got VIPT, volume and price tranche data for each day, does that offer a challenge to the benchmark pricing? So obviously we have the LBMA gold and silver prices each day, and they're picked at a particular point. I mean, I would aver that obviously it's really interesting to see where the bulk of the volume is for each day, but the benchmark prices are trying to do something different. I mean, the benchmarks used to be known as the fix, which, contrary to popular belief, actually came from sailing. You try and fix a position of a boat out at sea. You don't know quite where you are, so you take a fix to find out where you are. And that's what the LBMA auctions still do, is basically establish at 10:30 and 3 p.m. for gold and at midday for silver, where is the volume right now? Where is the market? And what clears the most business at those times of day? I think the VIPT data offers a really interesting comparison against that. And I think as we saw on some of the volume above and volume below charts earlier, I think it's really interesting to see, you know, to use that as a comparison against. I don't know, Saida, David, if you've got any comments on that?
Well, the VIPT, the way that's showing up is a VWAP, or volume weighted average price, and it's creating the tranches throughout the day, when obviously the auctions are for a few moments twice a day. And I think it's more of a regulatory question for a benchmark administrator to consider, and a prudential regulator, what is the best way to do that. The auction is traded, so that's obviously what is the preferred mechanism. But there are exchanges that are using VWAP, and it is a recognised and regulated format. Who's to say what's better or not? I don't know.
Mm-hmm. Saida, you got any comment on that?
Yeah, I guess you know, when analyzing volume in price tranches data, just came across some interesting observation. So, for instance, we've noticed that the spot market across the day tends to gravitate towards the benchmark price for the day. But there is no clear pattern on whether sort of the average price of spot transactions moves closer towards PM or AM fix in case of gold. So on some days we see that the mean price moves closer to the PM fix, while on other days it is closer to the morning fix.
Wow, okay. Okay, that, I mean, again, you know, this is what the VIPT data enables you to do, is to have a look at this and to compare it against the benchmarks and get more insight into what's happening in the market. One last one here, I think, David, this will be for you. NSFR. Obviously, it's, you know, getting a lot more attention again now. I know that the LBMA and the World Gold Council recently made a representation again on this. If NSFR is applied as currently planned, what do you think the impact would be on OTC volumes?
Well, I think you'll be able to measure that pretty soon, won't you? Because we've got implementation in Europe on the 28th of June and the 1st of July. United States, you're going to have to wait until January 2022 to see what that impact will be within the United Kingdom. I think what this set of data does in connection with NSFR is answer the question of providing data where it wasn't previously available. I think that was the problem for the precious metals markets and gold in particular. And now there's almost 3 years of data available. I would say that is no longer the reason why we shouldn't be able to pick various sets of data and look at it in stress points, in liquidity events, and compare it to other asset classes. And this can be done now. And recently we've seen some analysis coming from the pre-trade data side. So this is relevant for several reasons. It's providing the evidence that gold in particular has the credentials to meet the high quality liquid asset test. And I think that at some point it's going to have to be recognized and measured, because if you fulfilled all of the criteria that the Basel Commission says that you must fulfill to become an HQLA, and you can do that, then it's going to be interesting to see where the pushback comes. So I think that's where the data is really important. But the impact, I think, would have been noticed more in the last few months as you run up to it, where we haven't seen any big moves in rates. That would be a good indicator of what's happening to inventories vis-a-vis pressure from NSFR, and those rates haven't moved that much. So I would say that there's nothing telling us that anything is likely to happen once the implementation happens in June and July. Banks normally follow rules quite early before the implementation date, and we saw this with Tier 1 capital. People started to produce a lot of figures from their banks to say that they'd met all of the prudential requirements, and I think that's the case with NSFR. Basel do collect data twice a year, and you can find that on their website, that shows that almost all banks are above the 100% NSFR, and you can get a breakdown on gold for that as well. So it doesn't just do a calculation of a quantitative impact study for the whole market. For all of the asset classes, it breaks it down for gold as well. So you'll have to wait for the next one to come out. But the European Banking Authority are writing a piece on the RSF, so the 85% for gold, and that will be published after November when it's written. And it's been written for the European Commission. They don't have to abide by any of the recommendations if there are any. So that will be the next milestone really in the NSFR debate for us later on in the year.
Okay, thank you very much. One last one here, just quickly. How far back does the VIPT data go? Is that right back to the start of the project in 2018?
It should do. So on the NASDAQ service, you should be able to go back to the beginning in November 18, as you say. On the Refinitiv service, it's only going to be from when Refinitiv started to publish it.
Right. Okay. Okay. Thank you very much, guys. Taylor, I think over to you.
Oh, I'm here. Hi, thank you so much for joining us, David, Adrian, and Saida. Every time we do one of these webinars, I learn a little bit more. So it's really good to have you on board, and I'm sure everybody listening has learnt quite a bit more as well. So thank you very much. As mentioned at the beginning of the webinar, if you do have any questions that come to you after, or if you are watching this recorded, please do email them into us, and we will get them across to the speakers who can compile a nifty little response and send it back to you. We hope that you can join us for our webinars in the future. So the next webinar that we have will be in 2 weeks. On the 24th, we released the version 9 of the Responsible Gold Guidance a couple of days ago. So you can actually read that on our website. I think there's a link to all the changes as well that have been made between this and the last version. So we will have Ruth Kroll, the Chief Executive, and we will have Neil Harvey, the Chief Technical Officer, on that webinar. So do get along if you don't fancy reading a report and want to just listen to the webinar instead. Of course, you can do both. We also have some events coming up. So we have our AGM coming up on the 1st of July, and an in-person summer social that evening for our members. obviously if the government will allow us to have a party, it will be going ahead. So if you are a member, please do register for that. Registrations close for the party on the 21st of June. Following that, we do have our Global Precious Metals Conference running the 20th to the 21st of September. We hope you can all join. And the evening of the 20th, again, government regulations allowing us to do so, we will be holding a networking event that evening. So if you have any questions about that, again, send us an email, or you can go to any one of our social media accounts or our website. We've got all the details up there. So save the dates, register for the events in July, and I hope to see you again at the next webinar. Thank you to our speakers, and have a lovely evening, afternoon, weekend, wherever you are.